Buy the dip, investors helped the PSI bounce back last Friday after the sell-off due to the FTSE rebalancing. Meanwhile, the S&P 500 reached new highs before retreating intraday last Friday. Is the market exhausted at this point? Let's discuss. My name is Dan Slim and welcome to another episode of Monday Market Outlook. A couple of economic data came in last week, starting with inflation rate with a surprise to the upside, 3.4% versus the 3.1 consensus estimates. Also, employment data picked up to 4.5% last January, significantly up from 3.1% last December. Though, this was quite expected, coming off of the holiday season. But despite the initial shock from the inflation read and also the PSEi had to work around the FTSE rebalancing sell-off, this gave a buy-the-dip opportunity for investors to reject the 6,800 level to finish 104 points up last Friday, back within striking distance of 7,000. So meanwhile, let's look at some earnings from last week. DMC posting a net income of 24.7 billion, which was down 21%. Again, this was expected because it is largely influenced by SEC's earnings. Now, looking at the chart, DMCI still trending upwards, closing the week within the 1124, 1184 range. Again, we are looking to sell on rally, possibly around 1184, considering that they will announce dividends pretty soon. Mega World reporting record earnings, 26% up in 2023. But you know, Mega World is one of those stocks that, despite these earnings beat time and again, the stock just keeps going down. Fundamentals may be sound, but unless price action synchronizes with that, it's just not a stock that we are willing to touch at this point in time. Bloomberry Resorts announced an 85% surge in net income to 9.5 billion, though this was actually a bit short of analyst expectations of around 87%. Now, if we look at this chart, we can see that investors really weren't too excited about the spectacular earnings growth. And if we look further under the hood, this concern may lie behind the alarming decline in VIP revenues for a third quarter in a row. Now look at this decline, 172, 146, 129. These declines are quite significant. Now let's look at the overall gross gaming revenue. In the fourth quarter, there was a significant boost to 80 million. So considering this surge here, Bloomberry should have gained more. And if we look further under the hood, this boost was actually due to the other license category here, bingo and e-games, from around 12 million, it became 25 million. And look at the way this is happening. There seems to be other players in the market coming in to the bingo and e-game segment, with DigiPlus leading the way with 8.1 billion. So this could explain why DigiPlus is showing some signs of strength in the technical charts. Looking forward, the gaming industry could have some tailwinds as PAGCOR starts to standardize their gaming revenue shares. Now, if we look at this chart, we can see that PAGCOR is standardizing their gross gaming revenue share to 30%. So currently, eBingo share is 42% and this will go down to 30% by January of 2025. eCasino from 41 to 30%. Traditional bingo up from 20% to 30%. These operators of eBingo, eCasinos, and live sports betting will have a significant boost to their revenues, right? Next, we have AEV reflecting mixed revenues from its business units. Of course, AP still consists a majority of AEV's revenue stream at 67%, but AEV could be a conglomerate stock that to watch out for in 2024. We have to consider their Coca-Cola acquisition as well as Union Bank recovering from some one-time drag from the Citibank integration. So potentially some upside with AEV. Let's look at the charts. The recent pullback here could be an opportunity to accumulate. Price target for AEB is around 56 to 58, but I would probably wait at around 47.50 or 47 to enter for a better risk-reward ratio. Lastly, we have PLDT reporting more than double in net income. Revenues were up 3%. Core income up 3%. Where is this doubling in revenue coming from? If we look under the hood, look here, 2022, revenues were down 10.49 billion. What happened here? 48 billion overrun cost, right? So, but if we look at the historicals, we have 18.9, 22.52, 24.28, 26.37. I mean, from 26.37 to 26.61, minus this deviation here, this is not really an exciting number, right? So, if we look at PLDT's chart, nevertheless, it still hit 1,300 after dividends were announced at 46 pesos per share, which translates to around 3.5%. At least the good news is that PLDT's yield is at a healthy, around 8.5% for this year. So, I guess a good defensive stock to consider. Now, let's look at the overall industry scorecard, starting with financials. Again, banks reporting very strong earnings results, but maybe toppish due to net interest margins slowly declining. But again, price action is still strong, so we have to also take that into consideration. Consumer discretionary spending is on the rise, especially for the transportation sector. I mean, GT Cap reporting record car sales for January. A surge in travel and tourist spending here seems to point out a strong year for consumer discretionary. Of course, real estate will benefit from the boost once rate cuts start to happen. Utilities, still strong. Meralco, Manila Water, AP, showing strong results. There's reason to look forward to strong demand in 2024. Telco, as explained, moderate growth rates moving forward. Consumer staples still affected by rising input costs as well as inflationary pressures. Gaming, as mentioned, could have some tailwinds. Materials still weak, considering that coal and nickel prices are still in a decline. Conglomerates, of course, average, but we need to be selective here. SM will still be my top pick, with AC and probably AEV at second. So let's look at the PSEi charts. The market closed the week very strong, surging 104 points to end above our 6,900 critical zone here. Will this rally continue? We will have the balance of trade numbers on Tuesday, and then US CPI numbers Tuesday evening. So for Monday, Tuesday, maybe we consolidate here, especially that the market needs to digest these gains last Friday. A divergence here could be a concern, no? But so far, price action still points to another attempt towards 7,000. The hammer candle here is a good sign that buyers were quick to reject the 6,800 support, and our best scenario is for us to consolidate a bit of a pullback here and then surge to 7,000 in the next days or probably for next week. So for now, if you are looking for opportunities to buy, look for stocks that are close to their support levels. Ali here, starting to look interesting here at 33.20. SMPH, also a very interesting level here. I was able to get some shares here at 31.80. I'm also monitoring GT Cap, right? I was hoping it hits the 38 Fibonacci retracement here, but it bounced back from 673. So we'll see next week. RCR looks very interesting at 5.22. 0.38 fib was hit. 0.5 fib could be also a good zone to enter. Let's watch out for RCR in the coming days. Monde defending the 0.38 Fibonacci level. Hopefully it defends this zone here this week. No? So on to the global markets. Atlanta Fed Chair Raphael Bostic started the week reminding the markets that there is still no urgency for the Fed to cut rates just yet. No? So Bostic stressed that he needs to see more evidence that inflation will stay at the 2% level over time. Remember that the market is still pricing in at least 4 rate cuts this year. This was later mirrored by Fed Chair Jerome Powell in his Senate and House testimony. So we have consistent messaging from the Fed about being prudent with rate cuts this year. But a couple of employment numbers came in. ADP, 140,000 versus 150,000. JOLTS numbers came in, third straight month of decline. And then finally, unemployment numbers came in at 3.9% versus the 3.7% last January. And although the non-farm payrolls came in 275,000 versus 200,000, the previous 2 months numbers were significantly adjusted. January numbers came in at 353,000 and this was revised to 229,000. So this signals a significant softening of the labor markets, especially on top of that wage growth saw a significant drop to 0.1% month-on-month and 4.3% year-on-year. Again, a positive sign for the Fed's fight against inflation. So let's look at the S&P 500 charts. The labor markets caused stocks to surge after the open, pushing the S&P 500 to new highs before sellers came in and push stocks lower throughout the day. So we've had some similar signals here, 1, 2, 3, right? Which could mean that the S&P 500 may consolidate this week. CPI numbers will come in Tuesday. So we may have Monday consolidating, and then the movement here will depend on the inflation report on Tuesday. Some say the big swing here could be a sign of exhaustion, as we've actually been grinding up since October of last year. So much of this pullback here is actually because of Nvidia. There's a massive 11% single day swing here. So for a $2 trillion stock to have this kind of movement, especially with no company news whatsoever, could be a sign that the markets are exhausted at this point. On the other hand, if we look at the VIX, the volatility index, there's still no catalyst for the bears to come in, as we are still well below the 16-point level here. Now, let's look at the seasonality charts. We do tend to see March being a weak month, though that has not been the case for the S&P 500 so far. Could we proceed towards a mid-March weakness before going up? Looking at the yearly charts here, we are a bit overstretched and we are quite close to this correction zone here, considering that this is an election year where the sitting president is running. But we'll see how the S&P 500 reacts to the CPI numbers coming in at 8:30 p.m. Philippine time. So before the market opens Tuesday morning in the US. Meanwhile, Bitcoin also hitting all-time highs before pulling back to 68,000. So I've been getting a lot of queries if it's a good time to enter Bitcoin. Now, let's look at the rainbow charts here. We can see that Bitcoin tends to pull back during halving period. So we have a pullback here, and a consolidation here. So what will happen when we reach the halving period this April? So we are now in the yellow zone, so that's a hold. Let's wait for the halving period, see how it reacts. Maybe Bitcoin can enter the green zone here, which is around 55,000 to 65,000 level, after which we could probably consider going in, especially after the market is starting to estimate Bitcoin to hit a minimum of 100,000 per coin in the next couple of years. No? So we'll see. That's it for this week. Please like this video if you found the information useful. Please subscribe to the channel for more updates. Again, good luck on your trades. Please manage your risks accordingly. And I'll see you again next week. Bye-bye.